Good afternoon. Welcome to Chicago Future of Finance. I'm Oliver Rennick. We are here at the Cboe floor in Chicago, of course, on this Thursday with an hour left in the trading session. We got a very good show coming up. We'll be looking at the response to NVIDIA earnings, which is largely negative right now. We're going to have a lengthy conversation about the volatility landscape, which probably goes a good ways in explaining a lot of the action right now with Brent Kochuba at SpotGamma joining me from the top of the show as we catch up after a couple days where the market has been once again churning in place. This is all about a horizontal churn, but unfortunately NVIDIA led to a sell-off this morning after being stable last night after the earnings. But there's a few good things here again that just prevent me from getting too worried about the market. Number one is there is still a deep, entrenched negative view about AI, namely with that Citrini article that was circulating. I got a few thoughts on that in a moment, but here's the main technical setup. NVIDIA pulling back to 185, a 5.25% sell-off, certainly not the way you wanted this to go, but we had also just hit the top part of the range for NVIDIA, a gap up yesterday beyond that range, and we reverse it. So you test, you failed, it could be worse. We could be at the low end of that range, threatening to break down. Now the big cap tech in the mags more broadly is sort of hanging on by a thread to the low end of its range at $62, which is not encouraging. But the S&P 500 is right in the middle of the same range it's been in now pretty much since October last year. This is a lot of potential energy that is being compressed in the market that we hope will release to kinetic energy to the upside. You do have a bearish divergence that is starting to form, but here's the thing, we haven't really been making higher highs, so it's more just like a downtrend in momentum rather than a real dangerous bearish divergence. Still, it's not a great technical setup, but it certainly is also not the worst one. We continue to see a lot of single stock volatility while the index volatility remains fairly calm. It is at 18. VIX is still in this uptrend line that I've had, and it's holding it. But the fact that NVIDIA, one of the most important stocks in the market for the last 3 years, is getting walloped after earnings, and we're still holding into an 18 VIX instead of a 20, 21, 22, or 23 VIX where we've been, you can start to see a little bit of rollover in volatility, which hopefully breaks this line and we see volatility collapse. So we'll get into the details on the vol concept here with Brent in a moment. I want to just go back to my risk radar from yesterday because I did put the green light on the stocks and the yellow light onto Bitcoin in hopes that the risk appetite will continue to firm up. Notice though, yellow for gold, yellow for bonds, and yellow for the dollar. The charts there are interesting, but not quite to the point where I want to make any big changes just yet. Firstly, look at the dollar here for a moment. It's actually looking kind of strong, and you do have a little bit of an ascending triangle in the dollar now that we've seen a continued upside in higher lows, and that I think is interesting. Maybe the dollar will push above 98, in which I'd have to put the green light onto the dollar again for the short term. In terms of the bonds and the 10-year, the long-term lines that I'm watching for the 10-year have basically created this sideways triangle for bonds that also suggests a big move on the horizon, but it hasn't had a breakout just yet. But still, we're not pushing yields below 4%, which tells me the market is not too concerned about the backdrop, and I don't really think it should be. We saw a good consumer sentiment number earlier this week. Nothing alarming in the jobless claims or any of the data, but there is plenty of alarm in the category of AI breathlessness and drama, particularly around that article from Citrini that was going viral talking about ghost GDP. My 60-second thought on that real quick is that the concept of ghost GDP is inherently ridiculous. Unless you are a true disbeliever in capital markets, GDP and productivity or activity will always be found in some way. It will disperse in a way that makes sure the economy functions. And by the way, don't forget AI was born from the functioning capital markets. This is what happens when you plug money into our system and invention runs its course. This is just the best calculator we've ever had. There's white-collar displacement happening like we've never seen before, but that should open up the door for a lot of folks if you have any level of creativity whatsoever. I know that I've had plenty of ideas. I wish I had a coding team of 10 people. Well, guess what? Now you do, and you don't have to spend $1 million to pay for it. You can use AI. And by the way, don't forget, the first time we even launched this show, I talked about the notion that on the infinite time horizon, the machines should be doing more for us to free us up for time, for creativity. And how do we do that? By investing. That is the whole concept of the future of finance, is to invest in the disruptive forces so that you don't get left behind. Guess what happens if a company becomes highly productive and high margin starts creating massive amounts of profitability? They pay it back. It's called a dividend, my friends, and it is your hedge to AI. So that's the short thought on that. Let's talk some volatility. Let's look at the landscape here for the VIX and the potential for this market to pick a direction, perhaps sometime soon. Brent Kochuba joining me from SpotGamma as we think about VIX and volatility. Brent, good to see you on this Thursday. How you doing, my man?
I'm doing great, Oliver. How are you? Missed you, man.
Yeah, likewise. I was upset that we didn't get to see you in Vegas. You got trapped in the snow, but I know you had to take care of your kiddos with all the days off, and your boy Matt Fox held up pretty well as we talked about options with the good crew there at the Money Show.
I heard, yeah, snowpocalypse shut us down. So there's apocalypses everywhere. AI, snow, you know.
Yeah.
Hopefully not the real apocalypse.
One job that doesn't get AI'd away just yet, snowplow and dad at home.
Shoveling.
Yeah, right. And hopefully entertaining TV hosts. Lizzie, who did my great makeup today, that's a good job. She just opened up a business here in Chicago. If you're, so there's plenty
you
of
look
things
great,
here.
man. You're glowing.
Every now and then, every now and then. Brent, the market is doing something that is, though, kind of rare. This is an epic level of churn that we are going through. That I know there have been some examples. I can't really think of a ton off the top of my head. I would love if anyone in chat has a date for me in which the S&P has gone this far sideways. But the reason why I think it can be very healthy is that corrections happen one of two ways: through downside price action quickly, or through horizontal price action slowly.
Yeah, we're getting that slow churn. I mean, there's no doubt about that. And really, arguably today, you saw a 1% sell-off in the S&P. We hit this area where there's a big zero DTE put spread in the market. We tag that level and we bounce right back, right? Full mean reversion. And so, as sort of negative as people are reading the NVDA earnings, which seem to be kind of a beat, and we're still selling off, which, doesn't have a great look to it. Ultimately, that stock being down 5%, it could be back up 5% tomorrow and no one would bat an eye, right? So I just don't think there's a lot of great signal out of NVIDIA like what we would normally expect. I do think that the software stocks and seeing if we can get a bounce in that sector would be more meaningful. Hard to argue where they're getting a super strong bounce at that point. The implied vols are still very, very rich. I think the implied vols as a source of alpha, trading them is still great. Some really good short vol trades paid off yesterday in CRM, and I think with into tonight, you're going to get a similar thing because that implied vol and Z-scales and other ones, yes. But look, CRM, that's a nice bounce, and they announced a $50 billion buyback, Oliver. So if the AI apocalypse is coming for them, $50 billion doesn't sound like too smart of an idea unless they're trying to basically get rid of all their float by the time the AI takes them over. So, it's an interesting signal there. I think the other thing that I would take away from this market is that implied vol is getting crushed. It's coming down pretty hard. I know in the VIX you see it down a little bit today, but I was just looking at fixed strike vol, and we're down losing about a vol point for everything for the rest of this year. So PPI is tomorrow, but I really think at the end of the day, it's like, look, NVIDIA confirmed that people are still buying AI equipment. The software story maybe is a little bit too stretched to the downside here. That vol is a little bit expensive. So we're seeing the S&P vol really contract. We're still stuck in this range. Everyone's starting to understand that this is just the range at the moment. And so, at the moment, it's like maybe you don't want to buy stocks, but being short at this time, what's your thesis?
Yeah, that is a good point, because the short index also hasn't worked, Long index hasn't really worked. Short index hasn't really worked. If we kind of think, though, on the very margin here, I feel like this past week might be leaning more favorable for bulls, Brent, and please disagree with me if you do, but when I look at VVIX, our VVIX high was put in January, And it's been fairly range bound, even though it has kind of those higher lows like the VIX does as well. And also, please excuse my technical analysis on VIX, but until it stops working, I'm going to go ahead and stick with this line. But the VIX high was put in about 3 weeks after the VVIX high. And now with VIX kind of rolling over, I don't know, maybe we're starting to shake out enough single stock vol to where eventually this index vol will break. That's kind of where I'm leaning.
I mean, how do you not lean that way? The Bears have had a chance. They've had many chances. S&P broke 6,800 a couple times, and it bounces right back up. We had this dispersion where the software sector just got wrecked, and a lot of these leading Mag 7 names, right, also couldn't catch a bid. And arguably, maybe now some of them necessarily aren't that great looking if you taking Tesla and NVIDIA, for example. But the fact of the matter is that the market is not moving that much. And so I'm just trying to look up realized vol here for the S&P. On a 1 month basis, that's a 12, right? So we're moving at a 12% implied vol. The VIX is up there at 18. That's a 6-point spread roughly. Typically that spread averages, and that average can be a little noisy, but that average is around 3.5 points, right? So if you say, okay, 12 and a half implied vol plus 3.5 points, 15, 16 is fair in the VIX. So that just suggests that there's some vol premium to kind of suck out of this market, right? Pull that VIX down from 18-ish to 16-ish. We see the S&P fixed strike vol starting to come in. That should help the S&P to lift up, right? Because at the end of the day, the longer this market does sort of nothing, then that's this kind of vanna that comes in to help to lift the market up here. And there's just sort of a wall of worry, I guess, at this point. Because if you just destroy if the AI narrative is taking down GDP in such a manner that the Feds need to comment on this article, it's about as dour as you can get in terms of sentiment. But here we are, S&P basically unchanged since Thanksgiving. So it becomes a question about volatility. And we go back to this idea of volatility as an asset class. There's vol to extract in this market right now. So maybe you don't want to buy stocks, but short and vol doesn't seem like the worst thing in the world. Again, particularly in some of the stuff that's been so beat up.
The correlation also did, to your point, the attempt by bears in the first couple of weeks of February. We saw this Core 1M rise to 20 at the high. It started to come back down again. And, in moments where your correlation goes up, you often see the market at its worst. And if that was the market at its worst, maybe we don't have to go back to this super high dispersion, low correlation market again that might also be unsustainable to some degree, but maybe we just float with this Core 1M at 10, 12 range, which could be kind of a healthy reset.
Yeah, and I think the other thing that is interesting to think about here is we recently launched zero DTE, or Monday, Wednesday, Friday expirations, let's just say, in a handful of the mags, right, or all of the mags, and IBIT. And so, there are new flows coming into the market. I think the growth of options and the types of trades that are in the market now, which, may be perturbing or breaking historical norms, these can be exacerbated by these new options tools, right? And so it's a little too early to draw conclusions from that. But you wonder if something that is an aberration or a strange signal like the dispersion is really just a function of, obviously, these major flows that are in the market, and it's just exhaust from trading as opposed to a sentiment perspective, right? There are possibly other reasons that we're having some of this strange dispersion in the market, and obviously the dispersion trade is a big one. And so I think that's just something interesting to think about. In other words, do you want to extrapolate a lot of sort of macro or fundamental signal from some of these things that are happening, which may just be flows driven?
Good point. Brent, to break down, or rather to look at two specific areas that have been the most extreme in terms of dispersion, the weakness in cloud versus the strength in SMH. Yesterday, new highs for SMH, pulling back today. I talked about how that chart, both those charts looked bullish to me. So today, all right, fine, give me some flack for the next day being wrong, but I just think intermediate long term, the SMH chart still looks good. Even NVIDIA, and maybe less so mags, I'm feeling fairly hopeful about. But in the concept of dispersion, just kind of going to this idea of these two, of this giant gap, the spread in strength of hardware, weakness in software. Chat says, imagine the pain for those semi bulls if it's going to pull an IGV move and software rebounds and the divergent gap closes with software up, hardware down. It's a fun comment. I think I don't think so, frankly, but who knows? What do you think, Brent? I think it would be more like cloud just catches back up and semis are fine. I don't know, I have trouble seeing what the argument would be for why we'd flip those valuations back. I think it might be more of just cloud catching up.
Yeah, I mean, what I feel is that we're at a moment in time where it's very hard to predict what's going to happen in the next month in terms of the pace of innovation and what the impact is going to be. I mean, 6 months ago, I never heard of something like data centers or whatever in space. You know what I'm saying? And so it's like, I think it's very hard to say this is what everything is going to be a year, 2 years, 3 years in the future. And then here's going to be the impact of all this sort of stuff, right? So to the point of this is like, well, software is going to die because of AI, right? And all of the white collar jobs are going to go away, kind of to what you were saying before. It's like, well, is everyone's just going to lay down and die and accept that, or you're going to innovate and you're going to change and adapt and whatever? And so, I just think, again, when you look at CRM and they announce a $50 billion buyback, I don't think they do that if they feel like their entire business is about to be lost by AI. But again, I'm leaking into the fundamentals. The other thing that comes to my mind here is that one of the things that people were complaining about so much, particularly in the end of last year, was the concentration in the market, right? The idea that it was a handful of stocks, the top 8 stocks were 35% of the S&P 500 and over 35% or whatever it was of the weighting of the NASDAQ, for example, right? Well, the breadth now, if anything, seems to be, you could argue, improving. So now we don't necessarily have this uber concentration in the mags. I mean, I think they're still overweight, obviously, relative to, say, history, but maybe you want some of that breadth improving and some of the focus shifting to broad, the tech sector more broadly, for example, right? So maybe some of this stuff is healthy. I would also just say, Oliver, there are some things that look pretty dang good on charts. If you bring up IYT, for example, I'm, again, not a technician, but you look at something like that and you go like, SMH making a new high, is that typically a bearish thing? IYT looks like it's about to start, breaking out here. And so maybe there are some of these other sectors that are going to start taking the baton and leading us. And that would be, I think, a healthy thing for the market. Now, all of this stuff is outside of the options flows. The reason I care about this is because we have elevated implied volatility right now. And if you have sectors that look like they're more prone to breaking out, that suggests equity rotation and a relatively healthy market. And vol should start coming down. Implied vol should start coming down, which would put a bid into the market. And I think maybe people are focused a lot on tech at the moment, and there's some other developments happening, and maybe we just have to train ourselves off of, the narratives that have dominated for so long.
Good eyes on IYT. Big ascending triangle there, long-term trend to the upside, short-term correlation, consolidation rather. Oftentimes looks like a technical recipe for a breakout. Transports, we've seen the manufacturing market pick up again. And by the way, that's spread between cloud and SMH, like 38% up last 6 months for SMH, 14% down. So, 55% plus spread between those two, no joke. And I know semis are cyclical, obviously, but that's kind of the beauty of the pricing for a lot of these semis. Part of the reason why Micron and so many went ballistic is because they were trading literally at single-digit PEs for a long time. So I think it's hard to argue we're in the late cycle for semis. I like the IYT point as well, potential for rotation, nice to have, potential for other winners. I'm going to pull up SpotGamma here, Brent, to kind of get into the weeds of some of the flows data that we're talking about. And the intraday here, I've got Trace up for today. You mentioned at the top of our convo how the intraday action found, some support from...
yeah, so Oliver, if you just wind back to about 10:30, you can see there's those two big candles there on your left, right? Those are 0DT spreads. We call this the seek and destroy. And what happens is the market finds the biggest 0DT position. In this case, it was a 5,000 lot put spread there. The market will go down. It tags that level, and then we just, that's like, okay, the business is done for the day, and we tend to rally up. And you can see that's exactly what happened today, where the flows were very negative off the jump. What is that, Oliver? That's a flush through the zone that we've been flipping around in for the last 3 months. We tagged that level, and now we're all the way back to 6,900. And really, the only kind of truly negative thing on the day is NVIDIA. And NVIDIA minus 6%, that's a 50 basis point pressure on the Nasdaq itself, I believe, something in that neighborhood. So, outside of Nvidia is not that great after earnings, but ultimately these flows look pretty fine to me. There's some zero DTE noise in the morning there, and you can see that because as soon as we touch that level, it's just a complete mean reversion back up. And so, again, zero DTE driven noise on this day, and outside of that, it's overall pretty quiet. And software is bouncing, a little bit, and it's just kind of another day. It's really nothing to be that bearish or agitated about. And so again, that should indicate that vols come in.
And again, a potential catalyst too. And to the comment that someone had in chat about software going the way of, or hardware going the way of software, this would be the day where that type of thing starts. And a 5.5% move in NVIDIA, I mean, I think part of this is you're at the high end of the range, so it's more likely to kind of pull back there and reset after being range bound. But the other thing too is that that's not some big excursion from the expected move, right? I mean, isn't that what you're saying?
It was a 5% implied move, from yesterday. So
there you go.
You want to make the argument that
within the realm of options pricing.
It is, and you want to make the argument that the initial reaction was, had the stock over 200 and it faded that. Okay, fine, but this stock is also basically just completely jammed in the index, right? And so what does that mean? It means that the whole world owns NVIDIA stock, whether they intend to or not. There's a lot of call overriding in it. What does that mean? Well, I own NVIDIA. I want to get some extra yield. I sell some calls against it. You see the same thing in Apple and a lot of these other names where people want to increase their yield. So, it's a very mature name in the index, but also just in terms of everyone's holdings. And so I also think that you can't always take a ton of signal from the intraday moves on that. Because, what number do people want for the name to go up even more? It's just, I just don't think that there's a whole lot of surprise that's left in something like this. So I think that's interesting. And then on the other point of watching the implied vols, you have IV rank at 90 to 100 in a lot of these software stocks. And what that tells you is that options, if you own them, probably can't pay off anymore, right? They're so rich that owning them is basically almost a guarantee in terms of losing. The last time we saw stuff like this, Oliver, remember we were talking a lot about this with the metals, gold and silver, for example. And remember, silver printed 6 million contracts that day were across 115, and it promptly dropped like a stone, right? So there are these signals a lot of times in the options market that you can extrapolate and say, hey, away from the emotion of what people think is going to happen, the options prices are at these extremes, the volumes are at these extremes, and that can be a time for churn or change in price momentum. And so I think that's particularly true, again, in these moments where we see software, the sentiment is so bad, but the IV rank of 100 is telling you that everybody's in puts, everybody's expecting the worst. And if you want to buy a put when everyone's expecting the worst, that put is probably never going to pay off, right? So what do? Well, I guess I got to sell that put, right? Because that is the thing that makes sense, and that can help these names bounce. So, on that point, gold and silver now, IV ranks came way down in those. The options got much more reasonable, and those charts are looking like they're kind of re-engaging again, right? And you're seeing that gold and silver really start to lift. There was that issue at the COMEX yesterday, but you see those volumes start to percolate a little bit there, right, Oliver? And so I think there's just a lot of great signal on the extremes when you're looking at some of these options prices.
To see the rank for GLD and SLV on your top options volume kind of slipping a little bit in favor of some of the big tech names. That does kind of, it feels like, and largest daily volume over here on the right, gold fell way down in place of coin and Intuit, as you pointed out, going into earnings. So one of the questions I had yesterday with Phil Striebel was, is gold's volatility, even if it's been to the upside, going to create an issue for its traditional risk profile in a portfolio if now it's getting whipped around by options? So I think actually the cooling of some of these options flows in gold and silver is a positive.
I think that's the argument too, is like the stock up, vol up is a sure sign of something being overbought, right? Now it's always tricky to call a top in something like that, but when something is getting overbought, right? It can always get more overbought, but historically that, and it can feel really bad when silver's going from 90 to 95 to 100 to 110. You're like, well, I missed the whole thing. But then guess what happens? It unwinds and goes from SLV, the ETF goes from 115 to 70 in the course of a day, right? So that's that famous saying, kind of elevator up, escalator down, other way around, escalator up, elevator down. And that's kind of those situations when you're getting that frenetic stock up, vol ups kind of situation. And if those vols reset and the complex just sort of cools off, that's a better base for another leg higher. And that's sort of like when correlation goes, that core 1M metric goes like sub 8. What is that telling you? People are chasing into single stocks, and single stocks are overbought. We need that to cool off, and we need to sort of the environment sort of reset and make a bit more sense. And I think that is a really valuable thing. And right now it's software stocks where, look, index doesn't do anything right now, but there's a lot of vol premium in these software names, and I think they're very interesting trades, particularly with earnings, because earnings is an event in a time for vol to typically come off. And so when you're looking at ZS and Zscaler and Into tonight, unless they just absolutely prove the apocalypse is real, that vol should come in and it should generate at least a short-term bounce in some of these names. And maybe you just go where the water's warm, right? And that vol right now seems to be rich, and that may be a little bit of a more fruitful trade than trying to play an index range that just goes unchanged day after day after day.
Poor Captain Condor, just a month early, I guess.
That's right. And the vols are a lot richer now than when he was trading them. So, we'll see.
Well, maybe he's getting a second chance to spread his wings. Thanks, Brent. Great convo, great deep dive from the sector-specific stuff around earnings into the range. A little gold, silver chat there. Nice work. Appreciate the thoughts on the big tech stories. You the man, Brent Kochuba, SpotGamma. All right. We're going to take a short break. Then we're coming back with Scotty Bauer to talk about a sector that's working today that he put on our radar yesterday to watch, which is the banks, which are outperforming by a handful today. 3 days in a row, strength for the banks, bouncing with some conviction here. We'll be right back.
With increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% drop? At the end of the day, uncertainty remains a constant. Innovators' floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
All right, welcome back to the show here. We got stocks trying to hold in for the ride, not get dragged too hard by NVIDIA, which of course is getting smacked around, down about $11 right now. One group that is working on the day, financials up 1.2%, where we left Scott Bauer, Prosper Trading Academy yesterday. He was watching the group, and 3 days in a row now, Scotty, looking pretty good, these banks.
Yeah, and you know what? I like that today there's a lot of volume and we're higher. We're definitely higher today, but we're seeing JP up 1%, Goldman's up a little less than 1%. So if we can continue that, instead of a big spike back, but just kind of grinding here with a lot of volume, that says a lot to me. And that tells me that, the lows that we saw, I'm never going to say we put a bottom in, but the lows that we saw last week or so, they might be behind us. And I think there's a little confidence back in that sector. And, as we've talked about, I always like best in class. And to me, JP in Goldman Sachs right up at the top there.
Looks like a lot of technical support now has been established. Goldman,
Oh, yeah.
880. JP Morgan, about right under 300 perhaps.
Yeah, JP touched it right in that 295.7 area. Yep. And it bounced. It bounced real nicely. But this is the follow through, like I said, that I want to see where now, okay, let's just kind of get back to a little bit more normal trade instead of seeing, 3-4% rally or anything like that. This would really, really be positive for the banks overall.
How do you play it, Scott? You think this is just, you think vol's low enough here to just own premium, bank some calls?
It's definitely lower than it was earlier in the week. I'd still probably do this with spreads rather than outright calls or even like a time spread. I would rather do it with a spread, an upside like JP, maybe, the 310, 320, 315, 325, depending on how far I go out.
Okay.
For me, and we talked about, VIX yesterday, right? You and I talked about this. Could it break through that bottom? And it didn't. We saw it spike back up again. But here we are, after the big move in the market today where everything was under pressure. VIX has settled in now, only up, 80 bips after being up, well over 2+ points earlier. That area we were looking at as support yesterday, I think still comes into play. If we can hit that and break through that, Oliver, that's when I'm a buyer of premium, not just there, but in some of the equities as well.
Okay. So best in class, go for a JP Morgan or Goldman rather than the XLF. My KREs are holding in, regionals doing okay.
For sure. Absolutely. I think anywhere you go, even if you go to some of the smaller regional banks, you're going to be fine. I think those have probably a little bit more risk associated with them in terms of what the Fed might do in terms of, the pulse of interest rates. That's why I typically like to stay with the bigger ones, best in class. But, some of the regionals are pretty strong as well now.
So buying spreads in JP Morgan, selling a little upside for potentially the resistance, maybe at like 325. I got that on the chart here. I could see that. I think also this is a trade that pairs nicely for anyone who is generally optimistic on the market, but we got a lot of people that are very nervous, don't know what to do about tech.
For sure.
Brent brought up IYT, the transport strength. The idea of being able to pair some rotation strength, with a shot on tech. You could take a directional trade on tech. Let's say you really think you want to be short still, or maybe you think you really want to buy the dip, but pairing it with the long banks or the long transports allows you to, I think, embrace the idea of rotation as a different bullish view as well.
I agree with that. And it's not dissimilar from, the trade that you talked about for so long that was so unbelievable, short MSTR, right? Against pretty much everything else. So yes, you can certainly look at that. I do think we're going to get the opportunity, like we talked about and like we just mentioned. I do think you're going to get the opportunity to be able to buy some premium, some premium that has been a lot cheap or hasn't been this cheap in a long time.
Right.
We get through the weekend and there's always the geopolitical risk factor that's baked into the market, but we get through these talks with Iran and we get to Monday and we're kind of status quo here. That's really where, to me, we can see the VIX start to break through those lows. Overall, and I know today it's been a volatile market today, right? Wait, S&P's down 80 at their low here. Someone would have said to me, though, starting the day or last night after we saw NVIDIA printing 200 plus, that stock was going to be down. It's down over 5% today, but S&Ps would only be down 0.5%, and so on. I'd say that's a huge win.
I'm with you. I'm in the same boat. I think the same exact thing, that when you've got such a big leader getting smacked on earnings, certainly could be much worse. In fact, we've held in is pretty solid. And good eyes on the bank, Scott.
Thank you, sir. I appreciate it.
Nice call.
Every once in a while, right?
Yeah. Hey, I mean, 3 days in a row.
Yeah.
Kind of looks like they want to break out. Nice to find things outside the tech trade, so you don't have to make this big decision about tech that's making so many people nervous. Great stuff. Appreciate it, Scott.
Have a good one. Thank you.
You got it. Scotty Bauer, Prosper Trading Academy. All right, when we come back, make a 2-minute buffer break from Innovator, and then we're going to talk some ETFs with the Kingsview / Monarch team for the Cboe Exchange Traded Profile next. Don't miss it. These are really interesting funds we're going to get into when we come back.
With increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% drop? At the end of the day, uncertainty remains a constant. Innovator's floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
Welcome back to Chicago Future of Finance. I'm Oliver Rennick. It's time for another Chicago Board of Exchange, aka Cboe Exchange Traded Profile. I'm here with Yash Patel of Monarch Funds and also Kingsview. We've got two great funds that we're going to talk about that I think have been super interesting. Yash, it's great to meet you. It's great to have you here on the floor.
Thanks for having me, Oliver.
Tell me about kind of your guys' first year structure, because I think that's important to explain first to folks. Is Kingsview as an asset manager, Monarch Funds as an ETF shop? Tell me about how you guys work together and what that business model looks like.
Absolutely. So Kingsview is the asset manager. Monarch Funds is kind of our brand for all of our ETFs. And so all of our ETFs, we have 7 of them in total now, they're effectively index ETFs. They track indices that are created by Monarch, and then under the same brand umbrella, we have Monarch ETFs. So Kingsview, the RIA, Monarch is a brand for the ETFs.
Okay. Now, as you guys are talking with advisors, the ETF world, obviously a very competitive one. How do you kind of figure out what people want right now? And also in the year-to-date period, it's been kind of a tricky one. You know, like our guests, some of them absolutely love tech, some of them hate tech.
Yep.
People have been watching gold go berserk. People have been watching Bitcoin struggle.
Yep.
How do you kind of figure out what that market dynamic lends itself to from a product standpoint?
Yeah, great question. So I think one of the great things with what we're doing at Kingsview and our Monarch ETFs is we not only produce ETFs as an asset manager, but we also have advisors all over the country that work for Kingsview. They're Kingsview advisors. And so hundreds of advisors across the country, you're talking to your clients every day. We get direct feedback from them in terms of what clients are looking for, what they want, what's working and what's not working. And so that's nice, right? As opposed to somebody whose business is really just creating packaged products and selling them and having no kind of link there. So it's good to get that direct feedback from advisors in terms of what they're looking for. Our investment committee also obviously is thinking about all of our products and what we need and kind of marrying that together to say what can we do from a product innovation perspective and what are our advisors looking for. So that's kind of where the product idea set comes from. As you're talking about, what are we thinking about in terms of gold or different things? As I mentioned, all of our ETFs are index ETFs, and so the reality is we're not actually taking active plays on, I like gold now, or I don't like gold now, or here's how I feel about the AI boom or lack thereof. We're letting the indices, which have been built based on a lot of research, kind of do what they're doing, right? There's a defined methodology, there's no discretion from us as an investment committee in how these ETFs work. We follow the index. So the indices are built based on all of the back testing that we've done through time on various different products. They will prescribe what we're buying and selling, and that's what we'll execute in the ETFs.
This is where I think we should jump into the first one that I've been pretty impressed by researching and following it along, because I think it kind of answers some of the questions that people are trying to figure out. To your point, which is, where do you go? So you've got a fund that goes everywhere.
Yeah.
MVFG, let's talk about it. Monarch Volume Factor Global Unconstrained Index ETF. For context, in the last 52 weeks, this is up 32%.
Correct.
The S&P 500 is up 16%.
Correct.
The TLT is down 2%. Bitcoin's down 20%. Yeah. So unless you're benchmarking to just pure gold, which I know you're not,
that's not the case.
This is one heck of a fund. Tell me what you guys are doing here.
Yeah, for sure. So as the name says, it's our volume factor global unconstrained fund, and by definition, it's unconstrained. It can go anywhere, and it gets a global exposure. It is a fund of other ETFs, and so the general idea behind this product is we're trying to find out where money is flowing in the market and following those trends. So, from a technical perspective, a lot of people will look at price trends, they'll look at momentum, and often get whipsawed by that because they're chasing prices as they run up, or they kind of miss the bottom when they go out. Our belief for this particular index is that we should be looking at where the cash is actually flowing, right? Where is the direction of capital flow? And so if that direction of capital flow takes us to emerging markets, we'll go to emerging markets. If it takes us to miners, we'll go to miners. If it takes us to AI, we'll go to AI. And so it's a quarterly rebalance fund, and that's kind of where we've been. So we've seen varied exposure over time, but having that ability to be unconstrained, having that ability to go wherever the capital flows go really helps us be nimble. There's a second component to that story as well, which is on the risk side of things. One of the other things we'll do is we'll look at broad-based capital flows, and if we feel like they're going in the wrong direction, they're not going with where the markets are, we have the ability to de-risk the portfolio by moving into a partially or a fully defensive position.
Okay.
And so, all of this fits very well with our idea of diversification. Really being able to bring products into client portfolios that are different ideas and uncorrelated to whatever else they have, whether they're managing risk or whatever else it may be doing. So I know that's a lot to throw out there, but the message I would send in broad strokes is just that. Follow the cash flow, see where volume is going, follow the volume, and then go into any market area there it makes sense.
Right now, it seems like the approach has brought you guys to EM. Is it pretty big? 4.4%?
Correct.
You've got two different forms of EM in there, so I guess that kind of international rotation leadership is an important part of this right now?
Yeah, it is. That's where we're seeing the capital flow right now. So we've moved into EM. We've also got exposure to kind of mid caps and small caps. We're seeing capital flows go there as well, which perhaps, again, makes sense. We've been in a large cap rally for some time. It makes sense that people are kind of cooling off on that, if you will, and moving money to other places. So that's the story at present based on the last rebalance with EM exposure, mids and smalls.
When you're looking for, I guess, the alpha from here, one of the stories, of course, I mentioned gold. How does the trade in gold, silver work into the strategy of going anywhere? And has the risk profile changed of these assets based on their volatility over the last 6 months?
Yeah, great question. From our perspective, again, we're following volume. We're following where the cash flows. Where do we see the money moving? And we did actually see pretty sizable moves towards gold, towards silver, towards miners as well in general, particularly last year and the early part of this year. And so we followed that. No, not so much a view on volatility as much as that's where we see the cash moving. And so as money's moving into these areas, that's what we're following.
Okay. Where do you think the puck is going in terms of U.S. equity? And I've got the listings up right here.
Yeah.
I don't know some of these ETFs off the top of my head, so tell me kind of where the U.S. story boils down for you. Is I mean, I guess I see some Russell in here maybe?
We do.
Some mid-cap?
Yeah, we do. We still can maintain exposure to the U.S. U.S. exposure is still the majority of our portfolio. While we do have a component of EM and other international, at this point it's probably about a third or so.
Okay.
So we still like the U.S. equity story. As I mentioned earlier and you noted, we have shifted away a little bit from large caps more into mid and small. And again, I think that rotation makes a lot of sense. Take some profit from where we've seen runs. We've seen a lot of the big names, as I'm sure you've covered ad nauseum, NVDA and all these others, perhaps not today, but just over the last year have been running. And so moving away from that into some other market sectors.
How much does this also try and make the job easy for the advisor, putting it all in one place? I imagine that a Go Anywhere fund lends itself to maybe lower costs, lower fees perhaps, instead of having, because you're compiling ETFs on your own basically, so the fee gets kind of layered in.
Correct. So there's a fee to the ETF, and it's on top of the actual underlying ETFs that we hold. While this is an index product, the index it's managed is actually one that is active in the sense that it's not just, okay, pick the top 500 names based on market cap. So there's a lot of research and alpha generating work that goes into that, and so the fees kind of represent this. And to me, this is kind of a section of ETFs that's kind of new and opening up, right? Everybody's used to cheap beta. I can go buy IVV for a handful of basis points and get that. And then there's also the world of formerly active mutual funds and now active ETFs. It might be $1.25, $1.50 or more. We kind of sit in between, where we still have an active component to the index in that, as I mentioned, it's not passive. And so there's some fees from there. It's not quite as high as you would find in other active products, but we're not 7 basis point beta either. From an advisor perspective, I think it's a great fit for the portfolio.
Which I do think makes sense, by the way, because again, you're assuming some of that
Correct.
cost of putting these things together.
There's
as
research.
well, otherwise
That's
taken
right.
care of,
That's exactly right. That's exactly
at
right.
the manager level.
That's exactly right. So we're alleviating the need for research, which is, like, first and foremost, kind of what we do, right? There's a lot of work, a lot of back testing, a lot of understanding different market cycles and how these things perform, and really lifting that responsibility in some sense over to our investment committee to say, here's where we should buy and sell. So from the advisor perspective, it's great because now it gives them a single product that they can just drop in and get a diversified exposure to whatever else they might have in the client's portfolio. So they've got their standard equity fixed income blend within equity. Maybe they've got some international, they've got some domestic, they've got large, mid, whatever, but those are all passive exposures. This adds another layer to that. This adds a piece that can look like equities if it makes sense to. It can look like domestic equities if it makes sense. It could look like emerging. If we feel like now's not a good time in the market from capital flows perspective, we could de-risk and reduce the equity exposure as well. And it's all in one neat package with ETFs and the tax efficiency that comes with it. They don't have to buy and sell these underlying individual positions in client accounts and deal with kind of everything that comes with that.
Makes sense.
So
Let's talk some income.
Yeah.
The other fund that I wanted to talk about is MANB. This is Ambassador Income.
That's right.
Index. When I look at the income side of it, just kind of go straight to what's in here. I see MBS at the top of the list.
Yep.
I also see some treasuries in here.
Yep.
Kind of the belly of the curve, maybe.
Yep.
Tell me what your thoughts are in terms of how to, I guess, solve. I hesitate to call it the problem of the treasury portion of a traditional 60-40,
Sure.
but a lot of people argue that it is a problem. So I'm not one to try and inject like my own bias per se.
Sure.
I've got smart guests come on that say just
Yeah.
buy treasuries. They're going to be a good value. Other people believe that the use case of traditional bonds are dead. Where do you guys fall on that?
Look, I think treasuries will generally always have a place in client portfolios. I don't believe that the use case is necessarily dead. This product, Ambassador Income, works a little bit different. It's not necessarily taking a direct view on that. With Ambassador Income, we're really trying to provide clients a fixed income ETF that will not just stay with a particular credit risk or particular duration risk, but look at macro trends to figure out where are we in the stage of the economy, and based on that, tilt the fixed income portfolio to wherever we need it to be. And so think of it kind of the same thing. It's part of your fixed income allocation, but instead of being static, it will move around as necessary based on the economic cycle. And a lot of that work is really driven off of employment and employment figures and kind of what that predicts for the economic cycle. But it's not just that. We say, we can further diversify things by adding in something that's a little different to your traditional interest rate risk and credit risk and duration risk. And there's a small commodity component that goes into that ETF.
I see that IAU is in there.
That's right, IAU is in there. So we hold a small position in gold right now, which obviously has been volatile as of late, but it's generally worked well for us.
Interesting, by the way, that you've got gold in here on the income side as kind of in the category of maybe the bonds. So, and it's not like it's one of these like option on top of gold. This is just gold. And the principle of gold appreciation that you're hoping for, you will give as income to the holder of this.
It will go down as income to the holder. The idea here, it comes back to my earlier comments earlier about diversification. It's about giving people a different kind of fixed income, right? And so the reason that the gold is in there is to diversify away from your traditional fixed income risks a little bit. Like, it's still a fixed income product. It should act, breathe, and live like a fixed income product. It's not a commodity product. But by taking small allocations and moving them to different areas like commodities, we can make it more uncorrelated to the rest of the client's fixed income portfolio, and therefore we believe just improve risk-adjusted returns.
I will conclude by just pulling up the numbers. Here's MAMB.
Yeah.
I mean, it's looking pretty good, 8.5% for the last year. If this is supposed to replace the bonds, it's doing a much better job. The TLT down 1.8%. I mean, even if we go ag, 2.3%, which is up, maybe arguably a more fair comparison. Maybe LQD only up 2%. I don't know if you want to go down to the junky stuff. You've basically gone nowhere for a year. Which, by the way, all things considered, that's not bad for junk.
It's not bad.
It's not bad for considering what's going on. And then NVFG, volume factor of 33%. Yash, great stuff. Thanks for taking us through the details.
Thank you, Oliver. Thanks for having me.
Appreciate it very much. Yash Patel joining us from the King's View with the Monarch Funds for today's Cboe Exchange Traded Profile. We'll be right back. Joel Hawthorne's going to go into the bell with me as we figure out what to do with this NVIDIA sell-off right now. It's not the worst day ever, but the S&P 500 is still down. Check out the Russell, small caps up 0.5%. Be right back.
With increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% drop? At the end of the day, uncertainty remains a constant. Innovators' floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
Welcome back to Chicago Future of Finance. We got 6 minutes until the bell here. Mr. Joel Hawthorne is on the line. take us into the ringing here, Joel. I mean, I think this could be a lot worse of the day. You got the Russell actually pushing 0.5%, you know?
Yeah, man. Thanks for having me. Glad to be on today. I think we were kind of texting the past couple of days, just kind of talking about markets, talking shop. And it just seems like the narrative hasn't changed. I mean, for me, as I said, as I was saying to you, it feels like a lot of the individual sector leaders have detached from the indexes, right? And a lot of these names that have been under pressure, the index, especially particularly the SPX, 6,900, we've been in this range in that area since about November. And it's been just the same old song. So I think it's contributed to some of the short-term options that expire daily. The zero DT, obviously, we talk about that a lot. And SpotGamma does a really great job. I follow them on Twitter talking about that stuff. So I think that is a catalyst there. And I think there's other catalysts there to be said as well. But I think that's a large part.
Holding us up, right? Those flows being pretty constructive, I think.
Absolutely, absolutely. I definitely think it's holding us up because when you look at some of these names, I mean, look at NVIDIA today, right? And then you think about NVIDIA, just to talk just volume today. We're talking NVIDIA's volume today. We're literally talking about, I mean, it's the market leader today. I mean, we are well into some major numbers for volume just in the underlying. And we are down over 5%. If someone said to you, NVIDIA was down 5% and SPX was only down 0.5 point, you would be shocked. And several months back, it would be a shocker, right? And I think that's what we're seeing right now, that this is the new normal, at least for the time being.
I think that, to take a big hit for such a key name and then be able to hold in is important. I think also both Brent pointing out IYT, Scott pointing out XLF. I think that there are places you can go right now if you want to be long stocks without having to wade into the tech madness, the tech carnage, and then pick a side of AI. Why not just go, like, what do you think trains are going to run better or worse with AI? I'm going to say better. You think we've already seen cars run way better with AI. Tesla,
yeah.
So all this stuff feels like there are plenty of ways. And banks too, by the way, I do think they're going to run better with AI. They're going to be able to displace, the 100-hour work week of the first-year analyst.
I agree with you. I think, and I also, to piggyback on what you just said about, there are some ways to get long some stocks, even with kind of the carnage we're seeing in some of the names like NVIDIA. I think that's exactly what has to be done here from a trading perspective. I think when I think about it right now, I was saying to myself today, I was like, hey, in 6 months from now, are we going to look at a lot of these names right now and wish we had piled into those for a buy to dip kind of mindset and just kind of go along for the ride? When we get to midterms, when we get to November for after the elections, what will we be saying about some of these names then? And I think a lot of times, it could very well likely be possible that we'll be saying, man, I wish I would have bought those and held on to them going into the close of the year. So who know, it's such a nimble approach right now because we can't ignore volatility. It's kind of one of those things right now. Vol is not falling, even with so much resilience in the market. Vol is really looking like there's some concern, some fear. As I said as well, looking at your chart, man, a lot of people say you cannot put technical analysis on the VIX, but I'm just going to say your trend line's holding up. That's all I'm going to say. That's it.
Yeah, it's holding up. And I hope it does, and I hope it breaks, but that'll be a good test of it too, because if it does, if this trend line breaks and it goes down to like 14 in a hurry, I'm going to be taking a monster victory lap on the VIX technical analysis. Hey, Joel, real quick before the bell, I know you're kind of waiting for dust to settle, but what's your shopping list look like for stocks you want to get long?
A couple things. I was taking some profits. I was long previously here in some Microsoft. Still a little bit long in Microsoft right now. Want to play that. Another name that hasn't been moving to my liking as of late, but I still like it for a bit of a longer term play is Amazon. So Amazon and Microsoft have been two names that I really have been kind of jumping into as of late.
Like it. I think Microsoft probably has found good support at $400. I hope that trade to the downside has been overblown. Maybe we'll get answers tomorrow. I'm thinking more like next week, perhaps. Joel, thanks for being here. Thanks for taking us into the bell. Great stuff.
Thanks for having me.
You got it. Joel Hawthorne, professional trader, joining us on the line into the bell. And it was an up day for small caps, but a down day for most everything else, including the international trade. EFA, which dropped a bit, and the NASDAQ lost about 1%. Bitcoin down 2.5%. We'll see what happens overnight. Thanks for tuning in to Chicago Future of Finance. I'm Oliver Rennick. Thanks for being here this week. I will see you on Tuesday. Have a great night. Good luck tomorrow.